Good morning to you all.
Good morning, sir.
Good morning, sir.
Good
Had
morning,
a chance
sir.
of going through the previous sessions, presentations.
Yes, sir.
Okay, you can type and correspond with me. If you don't type with me, you know, I feel alone. I feel like, I'm not, people are not listening to me. Just chat with me. So once again, good morning to you all. What we looked at in last 2-3 weeks is that we spoke about fundraising, and we looked at different ways of raising funds, and then what it means, like what is the purpose of raising fund. We looked at, and we looked at ALCO meeting and its importance, and this class will be confined to few areas. Like we will talk on the deposit insurance, and we'll talk on the market risk. Okay. Okay. Can you all see the screen? Can you all see the screen?
Oh, yes, sir, we can.
Can you all see the screen? Can you type something?
Yes, sir, we can see.
Can you type something? Can you say that you can see the screen? You can hear me well?
Yes, sir.
Yes? Deafening silence from you all? Great. Right. Okay. Today we are going to look at deposit insurance first, right? Deposit insurance is that for the depositors, a scheme introduced by the government, introduced by the central bank, by the act enacted in 2010. After a few debacles, finance company failures, that every depositor will have to be paid a certain amount. So largely the reason for going for a deposit insurance scheme is that to safeguard the small investors, the depositors who are investing small amounts in the financial institutions, this by way of giving a assurance to them and then giving them the money back. So that it started with 200,000. Central bank said 200,000 to be paid to every depositor if something happens to the institution. If the institution is unable to pay the depositors, minimum of 200,000 to be paid per depositor, which has been increased in 2018 to 600,000. Right? Okay. Let's go into this. So as you can go through this and then see that except in deposits, the core deposit that requires effective risk management measure as a critically depends on the public confidence in the banks. So the insurance scheme introduced by the central bank, on that there is a premium. The banks and financial institutions will have to pay a premium to central bank. and the central bank has taken insurance, and so for that arrangement, taking insurance and then having reinsurance arrangement on that, they take a premium. So every bank will have to pay a premium. This is about once in 6 months. We pay a premium on that, on the deposit. So for that, all the deposits are taken into account, and on the deposits, now we will see what are the deposits which are to be taken into account. On that, premium is calculated, and every financial institution's current account with the central bank will be debited with that. Right. So this, as I told you, that this is to protect the public confidence and stability in the banking system. When you find that finance companies and banks fail, then the confidence in the financial system will be down, unless there is a insulating cover, if not for the full deposit, some assurance to the depositors that there is a scheme where central bank will, the government will come to the rescue of the depositors. The depositors will lose confidence in the financial system. So this is one of those schemes which is instilling confidence in the financial system. Any questions you have? We call it deposit insurance because of this. Oh, Pushan, right, okay, we will ensure. From the next one, we'll ensure that is shared. Right, okay, thanks. Right, that was the question, right, okay. So, Pushan wanted to say that the notes have not been shared till this morning. I will ensure that next time, a couple of days before you get it. Right. Okay. So this is a section which is governing this particular deposit insurance scheme, right? All licensed commercial banks shall ensure their deposit liabilities, like what I told you, in the deposit. This is a mandatory scheme. No, it's not optional. No financial institution can opt out that I don't want to pay the premium. No, everybody will have to be. So by virtue of this act, every financial institution has to be part of this particular thing, starting from 1st October 2010. So this part also is mandated. The commercial banks, licensed commercial banks, they need to disclose to the public in the advertisements while you're asking for deposits that the deposit have been insured. This is again to instill the confidence in the minds of the public, and a compensation up to 600,000. This was this came by way of an amendment from 5th of January to 2018. 600,000. Earlier it used to be 200,000. Okay, so that's about the deposit insurance. Do you have anything to ask about the deposit insurance? We said it's a safety net for the depositors, especially the small depositors. And the banks are mandated to pay a insurance premium. That is every 6 months you look at it in additional deposits, you will have to make the premium. Like in the sense, I mean, it's not that every 6 months you pay the premium, but then you will have to pay the premium, and then if there is any difference in the deposit liabilities for the additional, you will have to make the premium once in 6 months. That for the additional you will have to pay. Then that's about making the premium. And if something happens, if there is a bank run, something happened to the financial institution, the financial institution has become bankrupt and then unable to pay the depositors. At that point of time, the central bank will step in and then arrange to pay 600,000 per depositor who have been covered from the deposit insurance scheme. So any questions on this? Any question? Okay, fine, great. Let's go back to the. We will cover a little bit of the Basel II Capital Adequacy Framework. I hope we looked at the Basel II Capital Adequacy Framework, which basically has three pillars. I said pillar number one is basically you need to have credit risk. For the credit risk, how the capital to be allocated. And then there are two other risks which are to be, for that also you will have to have the capital allocated, which was brought in under Basel II, was that it was operational risk and market risk. So we will look at, last time we looked at the credit risk, and we looked at calculation for the credit risk. So credit risk, very briefly, is the counterparty risk what you have when you are given a loan, whether you can recover the loan, right? So that's the risk. So you need to have capital allocated for the credit risk. So for the credit risk, when you are doing the capital allocation only, you risk weight according to the guidance given by the central bank. The central bank will say you will have to risk weight your commercial loans and all 100%. That means if you are given 100,000, you will have to have a capital allocation of, let us say, if it is 10%, you need to, 10,000 capital allocation should be there for that. Likewise, if the capital weightage for gold loans, you all will have gold loans. Gold loans is 0, means you don't need to allocate capital. If it is 75%, so for 100,000, for 75,000, you will have a 10%. So that I mean that by that it will come down. So that's how you calculate the, you weight the, give the weightage based on the guidance given by the central bank, and you calculate the capital allocation for your portfolio. Right. Okay. Now today we will look at for operational risk how the capital allocation done. So what is operational risk? You should understand what is operational risk. So the risk defined as the risk of losing, risk of loss resulting from inadequate or failed internal processes, right? People and systems or from external events. What it means is that, say while you are working, you have all the internal systems and all that. But what happens is that you go and do a misposting, right? You do a misposting, and then you have internal controls, but then that was not sufficient enough to catch that. So you have done a misposting, and then the money has gone to somebody else. And by the time you realize, you see that the third party has withdrawn the money and gone, and you are not able to contact. So it's a loss, right? That's a loss. Say you are dispersing a loan. You have an approved loan for 100 million. You are dispersing the loan. While taking the security documents, you haven't properly executed the mortgage. If you haven't executed the mortgage properly, Then what happens is that if the customer defaults, your security is not perfect. So you will find it difficult to enforce that security. Either to go for a parate execution, either to go for a legal course to go and recover from that particular property. You will have issues if your security documentation has not been properly done. Right? Say, for example, you have, if you have taken a third-party mortgage, for example, you have taken a third-party mortgage, you haven't properly mentioned the party who mortgages, the mortgagee, obligo clause, you haven't properly covered. Then it becomes that you won't be able to enforce on the security. So that's a failed process, inadequate or failed internal process, right? Say there is a risk of our system failure, our system duplicated. We posted once and then it went and duplicated. So dual entry has gone. So the second entry they have they duplicated and then some suspense account has been debited. You find that the suspense account sometime later, and you find that you are not able to recover. So these are all operational risk, like what it is defined here. The loss resulting from inadequate or failed internal processes, right? People and systems. So it can be human errors, it can be system-based errors, it can be in the system, like in execution of the documents there can be an error, in execution of the transaction there it can be an error, it can be many in the checking processes which are weak, right? You have a checking process which has not been properly done. Due to that, there is a loss. So this is operational risk. On the operational risk, do you have any questions? Anything you would like to know on the operational risk? Okay. It's clear. Okay, under the operational risk, legal risk also will come. Like legal risk involves even exposure to fines. Let us say you haven't maintained okay. See, for example, there is a reputational loss. There's a reputational loss to a customer, and he is claiming damages by our failed processes. There is a reputational loss, right? Let us say we have taken an action against a person who is not the actual borrower, right? Some action has been taken, and then he finds it difficult that his name has been come in as a default or something like that, and then later you find out that he is not the. You have taken action against the wrong party. Then he claims damages, right? These are all operational risk, right? And then punitive measures, like central bank can charge us for not maintaining let us say the reserves properly, or else let us say customer's transaction has been done where you shouldn't have done. Let us say some foreign currency account on which you should not go and accept local currency deposits, local dollar deposit, but then you have accepted. Central bank sees and fines, right? Charges a fine. So these are all coming under these legal risk. So we are talking about exposure to fines, penalties, punitive damages resulting from supervisory actions, right? So these also will come under our operational risk. So under Basel II, they are talking about three methods, right? Three ways of calculating operational risk. So they talk about basic indicator approach, standardized approach, and the advanced measurement approach. Like what we discussed earlier, we go from the basic indicator approach, right? Go from the easiest way, basic indicator approach. Once we are quite okay with the other approaches, that we can do the calculation with that, and then we have a database ready and all that, we can go to the other one, provided the central bank gives the approval. The other approaches you can go for. That's more refined. All right. So here also the condition of central bank is that once from the basic indicator approach to the standardized approach or advanced measurement approach, if you are going, you won't be able to come back. You can't say that I want to come back to the basic indicator approach, right? So you are graduating from one level to the other, where is not that you can freely come down. So the director bank supervision also will keep on pressing the banks that you all use the basic indicator approach until the bank is ready, right? Okay, so what do we mean by this basic indicator approach? The basic indicator approach basically that calculates, you can see the particular formula, right? In this particular formula, the basic indicator approach, how the calculation done is that you take the gross annual income, right? Take the gross annual income with one provision that the gross annual income should be positive. If by any chance gross annual income had been negative in any of the 3 past years, we will not take that into account. Other 2 years only we will take, right? So you take the gross annual income of the financial institution, that's the total gross annual income that you totally tap, right? Into you multiply by a particular percentage which is given by the central bank. So the rate set is 15%, right? So the lambda thing what is mentioned, which is 15%. So what you do is that gross annual gross income, you total it for 3 years, multiply it by this 15%, and then divide it by 3. Right? That's the average you will take. So that will be the risk weighted amount for operational risk. This amount only you will add. We will, at some point of time, we will look at how the calculation goes. We will take one bank and then see how this calculation goes. For the time being, you must know, just understand, this is the way the risk weighted amount for the operational risk is calculated. Don't worry, I will not be testing you with how to calculate and show this, all that. I'm not going to. This is your knowledge. You need to have this knowledge. For your knowledge sake, you must know, and then qualitatively you should be able to comment on that. Right. So what I'm talking about is gross income, GI. The gross income is equivalent to the net interest income and non-interest income. You take the net interest income and non-interest income, and then you adjust it for the following. You don't take any provisions, impairments, right? Any unpaid interest. All that will have to be deducted. And gross operating expenses, fee paid to outsourcing service providers and all those operating expenses, and then fee received for providing outsourced services. Now there are some institutions which may be receiving payments, right? by the financial institution, the payments received for providing outsourced services. So certain things we outsource. I mean, we also do provide outsourced services. So for that, we receive an income, right? So that income also has to be adjusted balance only. You will take the gross income for the purpose of computation of the risk-weighted amount for operational risk. And then you will not take into account any unrealized profits arising from the, there is something called held for trading or held to maturity. The securities in the treasury you will find, we buy securities. Now like treasury bills, treasury bonds, other fixed income securities, and Sri Lanka development bond, let us say. Right. Any of these securities, the assets what is bought by the financial institution, there are two categories. Some category you will keep it till maturity, right? Once it is categorized as to be kept till maturity, it has to be. The other one is for short-term trading. The moment interest rates are fluctuating, this will be traded. For example, if we have some securities which we bought and there is an income of 10% on that, current yield rate has come down to, let us say, 6%. Then that can be sold above the market rate, right? So that can be sold above the market rate. So you get an income from that. So the bank and financial institution can keep those securities for trading. So right at the beginning of acquiring asset itself, it has to be classified whether it is held for trading or held to maturity. So any unrealized profits or losses arising from these will be excluded from this calculation of GI. And any non-recurrent income expenses not derived from ordinary activities of the bank, like let us say non-recurrent income, let us say we sold some sold up land, sold up building belonging to the bank, and then we got an income, right? So the purpose of this particular provision by the central bank is that we don't go and calculate and have capital allocated on activities which are of not the routine business type. For the routine business only, you will have to have these capital allocation, not for other one-off transactions. So that includes these any other income or expenses, right, which is not related to the ordinary activities of the bank. What are the ordinary activities of the bank? We do fee-based and fund-based activities, whether we give loan or whether for a fee we give some services, right? Are you all clear? Are you all okay? Are you all okay? Right, great. Some of these areas may be sometimes a bit boring. So strong suggestion is that you don't lie down in your bed and then listen to me, right? You start sleeping. So make it interesting, ask questions. I keep on telling in my classes is that what I say is that, anyway, this particular system of online studying is as its pluses and minuses. Now, when you look at the plus, if you are especially traveling from faraway places, especially for the class on Sunday, and sacrificing your weekend and then going back to your work and then hectic schedule and then the time spent with your families are much less and all that, this is a boon. Basically, this gives you a lot of flexibility to plan your time and have some quality time with the family, and then follow the classes with less wastage of time. The minus may be that the magical touch what we will have while in person in class when you are talking, seeing person to person, talking to you, and then sort of the interaction, the live interaction, that is a minus. Now, I keep on telling in my class to all the students is that these sessions, especially now you are doing a postgraduate course, now your days of doing A-levels long gone, days of doing banking diploma may be long gone, and you have come to the point of doing a postgraduate diploma. So in this, along with studying this, your leadership skills also should go up. Leadership skills, what I mean to say is that you should be able to, interact. A class of postgraduate level class should be of more of interaction than of lecturing. And people should be able to get up and then speak, do presentations, enter into live discussions. I mean, that actually build up your personality. That personality, what you build up from that kind of exercises, will make you at ease while you are going and facing your superiors in interview for your promotions. If you want to go up in your career, from a point of view, like, from the point where you have become an executive, it all depends on how you actually project yourself, how you show your, whether you have acquired knowledge while interacting with the customer, how you show that, you are knowledgeable while interacting with your seniors, superiors, whether it is your people from the management of the bank or financial institution, how you show yourself, how you are able to go and tell them, convince them, and then impress them. That is what matters in your upward moment in your career. It's not that, I have been working, putting my head down and then working like a bull in. So the amount of hard work what you have done would have taken you up to this level. But from this point onwards, for your career advancement, improvement in your career, you will have to develop other soft skills, and you will have to grow as a leader. That's very important. That's where I also keep on insisting you all to interact, talk, air your views, and discuss, right? Disagree. Those are like, builds you as a individual. So the postgraduate sessions normally should be not a lecturing session, but a discussion, right? It should be a discussion. So where sometimes both parties learn, right? These are few inputs for you all. I'm telling them, those are the things you must keep in mind as you go up in your career. Just because we have paper qualification, it doesn't push us forward. Now everybody is doing MBA, everybody is doing banking qualifications, and then everybody is doing so many other degrees. The competition is very high. So how do you show yourself, differentiate yourself, is that how you project yourself. So that's very important, that I keep on repeating, right? Though it's not part of this particular curriculum, that your improvement with this, I would be very happy to see that you have improved in that area too. Right? So the standardized approach is the next approach in calculating the risk weightage for the operational risk, right? So the TSA, the standardized approach, we need to have the director bank supervision's approval. They will look at our current, following how we are doing our current ones, and then only If they are satisfied, they will give an approval to go for the standardized approach. So under standardized approach, it is simple. The difference is that the banking activities are classified, right, into 8 business lines. So 8 business lines are your corporate finance, trading and sales, payment and settlement, agency services, asset management, retail brokerage, retail banking, and commercial banking. So these 8 areas, the operational areas are classified into 8 areas, right? So when you do into 8 areas, then you will have to calculate the gross income from each area, right? So that's what it means, that you will have to have these, the beta part, which to be multiplied by the gross income, right? And this way, what we will do, we will multiply for each and every area of the 8 areas what you mentioned, multiplied by the beta. Earlier we looked at is 15%. So here what happens is that every area now, like in the next slide you will see different weightage given. The beta factor given is that different. Like corporate finance 18%, trading and sales 18%, either because these are areas where its risk is high. In the agency services 15% risk is low, and asset management 12% risk is low. Retail banking where risk is spread, so that is low, 12%, and commercial banking 15%. So this way what happens is that according to the guideline, this way what happens is that
Excuse me, sir.
Individually you multiply the gross income from that line into these rates for beta, which is given percentages, and then that actually you total it up, and then for 3 years, and then divided by 3. So that's about this particular calculation. So don't worry, I am not going to give you the figures, so I am not going to give you a sum to go and calculate this and tell me what is the capital allocation has to be done, what is the risk weightage has to be given, what is the capital allocation to be done for the operation risk. I am not going to ask you. This is only for your knowledge.
Excuse me, sir.
Now, the next approach is that the operational risk capital requirement methodology, it is the same, except for retail and commercial banking. For these business lines, outstanding amount of loans and advances needs to be used after multiplying a fixed factor M as the exposure indicator, which replaces the gross income. So here the calculation, if you see, it comes as for these 3 years, for 6 business lines, you will calculate the way we have done earlier. And this particular 2 lines, where what we looked at, the retail banking and commercial banking, there is another fixed factor like that also, 0.35 with the beta LA. That means what? I have described that also. The total outstanding of loans and advances of the retail banking business lines, which you are multiplying by a 0.35. So this is retail bank. LAR means for retail banking, total outstanding loans and advances. LAC means for the commercial banking, right? So the final 2 calculations where you see is the difference. Between the standardized approach and alternative standardized approach. So look at it, ask any questions. I do not think that you need to learn this by heart. The formulas, you don't need to learn this by heart, but you should know that, I mean, there is the rationality behind calculating this way. Basically, here what happens is that they are segregating the business lines and then taking the gross income from that separately, especially the retail lending and then commercial lending. They are taking separately, multiplying by a different factor, and then with that, so that, I mean, the capital allocation will be lower than the previous one, more refined.
Excuse me, sir. Can you hear me?
So like what I told you, don't worry that you will not be tested on the formula, how to write the formula and all that, but you should know these things are there. Yeah, Damayanti, I didn't understand. You can't hear us. Yeah, I can't hear you.
Hello, sir.
You have to do?
Can you hear us?
Okay. Okay. Right. Let me call the yeah, correct. I can't hear you. Let me call assistance. Give me a sec. Okay. Tilipan, basic indicator approach has 15% of GI, but in standardized approach, different weightages except retail banking all skewed to 15% or more, which makes basic indicator attractive. Yeah, correct. You are right. It makes it because I mean, you know, you make it easier, and then as it goes along, you make it a little bit tougher. True enough. It has its pluses and minuses. True enough. Right. Okay. Till my assistance comes, we will look at. But anyway, you raise your questions. Yeah, one sec, please. I will have assistance now.
ළමයි කතා කරන එක මට ඇහෙන්නේ නැහැ.
Yeah. Now one of you can. Yeah. Can you please speak? One of you.
Can you hear us, sir?
Yeah. Correct. Yeah. Now it's okay. Thank you so much. Okay. Thank you. Right. All right. Now you can talk.
So any bank moved up towards the higher forms?
Any bank has gone for the higher versions?
Yes, sir.
I, of course, did not hear that they have gone for higher versions. Still, central bank is a bit, lenient on that. But let me check it out. Let me check it out in the market also. By the next class, I will see that I will give you the information from my finance and accounts department. I'll check it out with them, like whether it is there. Okay. Any more questions? So we will go into having a bit of corporate governance. Now, last time also I touched on the corporate governance. The corporate governance is very important in a financial institution is because success or failure of a financial institution depends on the corporate governance also. That's why there is a lot of importance for corporate governance. Now, if the corporate governance is not properly in place, if they don't follow the corporate, governance code properly, or the best practices, you can see that, in all the failed, now in my previous sessions and all that, I used to give them assignments on these failed financial institutions, because that's a lot of learning. Whether it is a Pramukha Bank or whether it is different finance companies, or you find lots of finance companies failing. Pramukha Bank is a bank which was started and then that failed. Everywhere when you go and see that, you will find that the corporate governance, there is a issue, right? Corporate governance issue is there. So this is a very important area because we financial institutions are like what from the beginning I'm telling you is that we are depending on the public, deposits. Mostly people are to depend on the public deposits. The other deposits what we are getting from the interbank market, or whether the capital what we are raising, additional capital what we are raising, and all that is a fraction of the customer deposits. So we are the custodian of public money, and then it all depends on how prudently we are managing the public money and generating profit for the stakeholders, and looking after the interest of the depositors as well as borrowers. So now, unless there is in the governance, if the management is extremely careful, extremely professional, there's every chance that the financial institution can fall into trouble, right? We have ample examples for this. So when you get time, just go and take the failed financial institutions in Sri Lanka alone, and then go back and see what are the reasons for failure. So you will learn a lot from that. I used to have some presentations also by the students. I'll group the students into various groups, and then I ask them to present on various things like this. So they come and present. Very good learning. It shows the amount of failures coming from the management of the financial institution, which has led to. Now what happens is that, if a private company which fails, means the investor or the owner or the shareholders, they lose the money. So, but then the numbers may be less. If it's a private limited liability company, the people who are going to lose by their own actions, or due to the environment, due to the things which is beyond their control, if the company fails, they lose. But if a financial institution, that too systemically important, say institution, if it fails, it not only is a problem for the investors, for the shareholders, it is a big problem for a host of other people. So it's an issue for the shareholders, it's an issue for the depositors, issue for the borrowers and the regulators and public at large and the economy, right? That's why we call it systemically important banks, because if something happens to such banks, it will have a huge economic impact, right? So in that sense is what we are talking about, this corporate governance. But we looked at the last class also, one slide I put. So little by little we will study on this corporate governance, which is very important. So the responsibility of the board is spelled out in the corporate governance code, is that the management of the affairs of the bank, conduct of business, maintenance of prudent risk management mechanisms, safety and soundness of the bank grossly lies on the board of directors, right? They have the responsibility, they have the accountability. They are the ones at a macro level, they are the ones who are responsible. So the structure of the management structure, how the management structure should be, is the prerogative of the board. They will determine. They will determine the structure of the management, and they will have to delegate business operation to key management personnel. We call it KMPs, key management personnel, right? They are in the corporate management. So they delegate. I mean, key management personnel will be in charge of, let us say, different banks have different structures. Let's say we call like deputy general managers, assistant general managers, and all that. Okay, deputy general manager corporate banking, we look after the corporate banking. Deputy general manager personal banking or retail banking, we look after the retail banking. Deputy general manager treasury, we look after the treasury operations, right? So like that, deputy general manager human resources, HR, we look after the HR. So at that, I mean, it doesn't need to be deputy general manager, it may be some other way of calling, right? Vice president, senior vice president, like that. I mean, there are different institutions have different way of calling their KMPs, right? So the delegating the business operation to such people to run the business is also a duty of the board. The policy making and risk management also is a duty of the board, right? So like what I told you, KMPs are defined, right? They are defined in the international accounting standards also, they are defined. KMPs are the people who are mostly responsible for the conduct of the respective business lines as well as the back office operations. So allocation of the job and giving the key performance indicators, that comes under the purview of the board, right? This is a concept you must keep in mind, which is important. The board is composed of a healthy mix of executive. Now there are in directors, you call various types. One is executive director. Executive director or executive directors are the people who are actually employees of the institution. They are employees and serving in the board, right? They are executive directors. That's what we call executive director. There's the one who is working for the institution, and they are employees. And then they are serving in the board also. They have 1 or 2 board seats. So they are executive director. So many a time we call it a CEO and executive director. chief operating officer and executive director. Like that we call. So depending on the size of the institution, there may be more people serving in the board. So that's one type is executive director. Non-executive director is someone who is not an employee, who only serves in the board, who is not an active employee. So non-executive directors, they will only come and participate in the board meetings. Right? They will not come and see what is the day-to-day business going on and all that kind of thing. They will just come for the meeting, and maybe they may be serving in subcommittees. Board will have subcommittees like board credit committee, board risk committee, board technology committee, right? Board nomination committee. Like that, there may be many subcommittees will be there. So they will be serving in the subcommittees in the capacity of members or chairman of those subcommittees, and then in the board meeting. So they will come for those meetings. So they are non-executive directors. They don't take part in the day-to-day running of the business. They don't come and work for the day-to-day running of the business. Non-executive directors. And there are independent non-executive directors are people who are brought in to kind of bring in a flavor of independence. Like, I mean, you know, they don't have any interest in the company. Like, I mean, they are not shareholders. They are not representative of shareholders. For example, in Sampath Bank, let us say Sampath Bank, okay, Mr. Dhammika Pereira has shares. Let's say because of he having high amount of shares in Sampath Bank, he is appointing somebody as a director or chairman. They are not independent non-executive director. They are dependent on whom they are representing a shareholder group, and shareholder they are representing. Let's say in any of the board, IFC is coming and taking some shares. IFC will come in, I mean, they invest and then they appoint a director. So when they have sizable amount like close to 10% or something when of the bank, when they invest, they will always ask for a board seat. So you give, I mean, they become a director. So they are not independent director. They are dependent. They are appointed by the IFC. So that's the difference between executive director, non-executive director, independent director, right? So the board's composition should ensure a balance of skills and experience, right? So people should have, so many of the boards will have a mix of experience. Like, I mean, people who are in legal profession, people who are in finance profession, banking and finance, sometimes people who are in the educational this one background, like, I mean, people who are like, I mean, vice chancellors and all that. Like that, I mean, it'll have a you know, skill and experience. A mix of that will be there represented at the board level. So, okay, board's functions, you know, what are their main function, and how the directors are appointed, what are the types of directors. Do you have any questions? Okay, go ahead. If you have any questions. No questions? Are you all clear? Okay. So the board, when you look at the functions, important functions of the board should have a formal schedule of matters specifically reserved to it for decision, right? So now we need to really segregate what, this is a very sensitive issue. What the board, what are the affairs the board will look after and what are the affairs the management will look after, right? So everywhere there will be issues between the management and then the board, right? So the drawing a line and then clearly demarcating is very, very important, because everywhere the management is the agent of the board. So there's always an agency problem. It will be there. For example, let us say the management wants to increase the salaries of the executive card of the bank. The board will have concerns. Board will say that, okay, only last year or 2 years back you raised the salaries by a percentage. Now it is not required. And this will have impact on the profitability of the bank, and then this will have a sustainable effect on the profitability of the bank if we are trying to do that, because it increases in a difficult time, it increases the cost higher, and then it's going to continue. So board will have reservations on doing that, but the management would like to do that. Management will have its own reasons now that the cost of living has gone really up, and then people are finding it difficult, and then people are incurring a lot of cost of having other infrastructure done for them and all that kind of thing. There can be a host of things which where there can be disagreement between the management and the board. So the board should have a formal schedule of matters specifically reserved to it for its decision. Board should also give clear direction to the key management personnel as to matters that should be approved by the board before decisions are made by key management personnel on behalf of the bank. So we'll have to say what are the issues which has to be taken to the board level for approval. What are the things where you will take the decision as the key management personnel? What are the areas where you will take the decision? What are the areas you will take the board, right? So that clarity should be there by way of a policy. So there has to be a written down document. It has to be clearly spelled out. So like what I told you, there has to be a clear demarcation, clear differentiation, clear demarcation between the executive functions and board functions. The executive functions are headed by the CEO, Chief Executive Officer of the institution, and the Chief Executive Officer may be a board member, director, or may not be, right? Either way, there has to be a clear demarcation what the management will do and what the board will do. So this particular, a smooth running of a financial institution relies on the relationship between the management and the board too. If they are in loggerheads, if everything what the management does, if the board, disagrees and all that, there will be a lot of disturbances which will affect the, successful running of the organization. So the CEO his way of operating should be in line with the board approved strategic objectives, corporate values, overall risk policy, risk management procedures, all that like that. Just because he has a confidence on a particular customer, he can't go and approve a loan using his limit, which is outside the risk parameters set by the bank, by the board. Right, because all the policies, integrated risk management, or risk policies, all that will be with a lending policy or lending guidelines or credit policy, risk management policies. All these will be approved by the board. It has to be tabled at the board and approved. So it is the responsibility of the CEO and down the line to toe the line and ensure that they don't violate it. So if they violate it, they become answerable to the board. So the board only appoints a chairman out of the directors who are there. They appoint a chairman, right? They appoint a chairman. Board appoints a chairman and the chief executive officer. So the chief executive officer may be sourced from inside, from the existing employees. A senior employee will be selected as the chief executive officer, or in extreme situations, people are sourced from the market. From outside, a CEO may come. So the other sensitive issue, like what I told you, is that the responsibilities between the chairman and the chief executive officer has to be clearly defined. Otherwise, what will happen is that if the chairman goes and puts his head into the routine works of CEO, it will become a problem. It will become a problem for the successful running of the organization. Right. Any question up to now? Any question you have?
Central bank also should approve those decisions.
Yeah, central bank should now. What happens is that appointments and all central bank will approve. Now these are the corporate governance also is issued now with the help of Chartered Institute of Chartered Accountants of Sri Lanka. Also they also contribute, and then these governance code is issued by the central bank. And central bank, I mean, in appointing KMP, central bank approval is needed. Key management personnel, when they are appointed, central bank, approval also should be obtained normally from the point of appointing. Within 15 days, approval should be taken. Prior approval will be needed before appointing, CEOs. So the central bank's approval is needed, which is there. But then the people who are recommending, who are selecting, will be the board. Board will select. So in selecting the key management personnel, even the executive directors will not have a say. They only can recommend, but the board non-executive directors will only take the decision.
So what is the fit and proper test?
Hello?
What is the fit and proper test?
What is the fit and proper test? Yeah. Fit and proper test is that you look at the competency of the person, whether they are conforming to the minimum requirements for the position. For a CEO means what is the basic requirements spelled out, whether you are meeting with that. Right? You are meeting with that. For example, like your track record will be looked at, whether you have the sufficient qualification that will be looked at, and then if there are any violations in the past which has happened, your record will be looked at. So that's a fit and proper test.
Is that carried out by a central bank or board of directors?
It's in the prerogative of central bank. It is the central bank's this one. Central bank will give the guidelines. Based on that, we will have to do that and then inform the central bank. So now let us say for the central bank in the approval, we are actually mentioning about all these things and then sending, and then if they have a question, if they don't approve, we have failed in our fit and proper test. Right? Clear?
Yes, sir, clear.
Okay, thank you. So the other thing what you need to understand is that the board appoints so many committees. So the board will appoint, you will have a board audit committee. So the board audit committee will be in charge of, looking at all the internal audit functions and approving external audit, external auditors being approved. Internal audit, how the audit charter has to be approved by the board audit committee. They will see annually how many audits to be conducted, what type of audits to be conducted, whether outsourcing audit services are needed. All these things will be approved by the board audit committee. So the audit reports from the periodical audit, significant findings will be referred to board audit committee. Board audit committee will look at it and review. And board audit committee will decide the appointment of external auditors. Periodical external auditors, they will approve. Based on their approval only, then the central will have to apply to central bank. So these are things which comes under the purview of board audit committee, right? Even before releasing the results, quarterly results or annual results, it need to be run through the board audit committee. Board audit committee has to approve. It has to recommend to the board. So with that only, at the board meeting, it will be released. Let's say every 3 months, quarterly financials are released to the Colombo Stock Exchange for the quoted public public companies. So all those things need to be approved by the board audit committee, right? Board audit committee, then to the board. Then selection, remuneration, like what I told you, like all the even KMPs and all are selected and all that. That you have board, board nomination committee. Board nomination committee will have interviews and then select people. So names might differ a little bit here and there with the financial institutions also, but then these functions are basically carried out by the board selection committee, board remuneration committee. So that will decide on the approval of the salary schemes, raises, salary schemes, for all the cadres in the bank, increment so much, a bonus so much, all that has to be approved by the remuneration committee of the board remuneration committee. Integrated risk management. Integrated risk management, there will be committees like board integrated risk management committee. So which will look at the adequacy of risk measures, and then they will review the risk policies, and then they will look at whether the bank is complying with the the policies. Those issues comes under the purview of integrated risk management. So they will look at all the significant incidents taking place in the bank, and then what kind of controls the bank has, and all that will be looked at by the board integrated risk management committee. So you have a host of other committees like that. Board credit committee will look at, there are credit papers which will, the higher limits will be referred to board credit committee. So board credit committee will either approve within their limit or they will recommend to the board's approval, right? So those are different. Those are called board subcommittees. So these board subcommittees basically helps the board overall to have proper oversight over all the business areas of the bank. There may be strategy committees, board strategy committee to form strategies and all that. So there can be board asset liability committee, like what I told you earlier. ALCO can be operating at the management level as well as in the board level also. The corporate governance is very careful about one particular area where, like, the by virtue of being the director of the institution, the directors, chairman, or related parties, they don't get undue advantage. Undue advantage is that, I mean, whether to their own, firms or related firms or whatever, on preferred basis, having loans or other facilities, like, which is given in a very preferred way compared to the other general customers. So those are contentious issues as far as corporate governance is concerned. So there are measures to stop that, right? So the related party transaction need to be declared. It should be declared. There should not be more favorable treatment given to them. It doesn't matter. You can lend, let us say, a director or chairman, yes, some other companies to which the bank or financial institution is lending. So okay, it's okay, but it should not be like more favorable way. It should not be done, and that should be declared in the annual accounts also. That should be declared. That's the requirement, right? Related party transaction. Okay, he will okay, before going into the composition, board's composition, do you have any questions on related party transactions and all that? You all will be working with various institutions where you will have your directors, and then directors will have other business interests, and then how your institution treats, how your institution segregates, how your institution ensures that no favorable treatment given, just because they are directors. You can have a look at it and see how these are declared in your annual report, how these are declared in your periodical accounts. You can see that, right? You can see. Any questions here? Have any questions? Basically, I do not know of any bonus being paid to the board of directors. Board of directors are paid a fees. A director's fees is paid. So that's depending on the number of meetings they are participating, they are paid. So I have no knowledge about any bonus being paid to them, because they don't, they are not, working or executives of the, organization. They are serving in the director board, and then director fees will be paid to them. Right. Dick Manoj, your question, are you okay?
Yes, sir.
Okay. Any other questions? Okay, let's look at the board's composition. How the board is composed of. So according to the central bank's guidelines, the number of directors on the board shall not be less than 7. A minimum of 7 should be there for a bank, and not more than 13. Right. So the total period of service of a director, other than a director who holds the position of chief executive officer, shall not exceed 9 years. You would see that in your banks, in your financial institution, you will see that, I mean, this is a code which was brought in so that no director unduly influences the board or have undue say in the bank. So the maximum period a director can serve, as a director, he could have been a director, he could have been a deputy chairman, he could have been a chairman, whatever may be. But the period should not exceed 9 years. So when someone has come to the board, let us say to your board, someone has come in 2011, now 2020, they will retire, right? That is a requirement by the central bank. So maximum period is 9 years.
Excuse me, sir.
Yes.
Can he join after 2 years of retirement of 9 years age? 9 years?
I hope so. There is a cool-off period. There is a cool-off period. I need to exactly look at that particular thing, but as far as I remember, there is a cool-off period. After that, they can
join again, no?
Yeah, they can join again. But let me confirm that. I'm not exactly sure. I think of the cool-off period is there. Like, I mean, 2 years or something, and then after that, they are available to be. I mean, they can be taken in. But in fact, I need to look at it. There can be some more conditions on that. Some more conditions on that. I need to. I'll clarify that particular thing.
Okay, sir. Thank you.
Offhand, I'm not able to tell you. Right. So, like what I told you, the 9-year period will not, apply to the executive director. Executive director, like what I told you, is an employee. So, employee can be any number of years, right, until their retirement age, as per the policy of the bank. So executive director it will not apply. For non-executive directors only, this 9-year period applies. So like what we earlier discussed, the employee of a bank may be appointed, elected or nominated as a director of the bank, as a executive director. So there cannot be many CEO executive directors. Only one CEO will be there, CEO executive director. The other requirement is that the board should have at least 3 independent non-executive directors. This is why you will find in the boards people of from different streams coming into the board. They will not have any kind of any pressure. Like, I mean, they will be independent. Like, I mean, in their decisions, in their views, they will be independent. They will not be representing any particular stakeholder group. They will be representing the general public. They will be like I mean, the public, what the kind of interest what they have, they will represent it. Other than that, they are not going to say, see that the profitability of a larger shareholder or whatever. They will not do that. So this is a good governance measure where the central bank asks at least 3 independent non-executive directors, or else 1/3 of the total directors. So basically, it has to be 1/3 of a minimum of 3.
So, is that role the board should compose with at least 7 directors applicable for state banks too?
You are not clear. Yeah.
That role the board should compose with at least 7 directors.
Yes.
Is that applicable with state bank too?
State bank different. The state bank is different. That because state banks, you have separate statute under which it is established, and then that as a effect of surpassing this particular central bank's governance also. So there may be slight difference there. When it comes to state banks, if it is like, Bank of Ceylon, People's Bank, and then NSB and all that, you have incorporated under a separate statute. So there may be slight differences in that. So if that allows, that particular statute allows that, this many directors should be there and all that, that can circumvent this. That can be more powerful than this. So I actually haven't gone into that statute. These are the central bank's, code for the licensed commercial banks. Licensed commercial banks. That part, now Bank of Ceylon, how many directors are there?
As per my knowledge, 6.
6 directors. Oh, okay. If it is 6 directors, they are complying now. But there has to be minimum 7. There has to be. Are you telling including the chairman?
Yes, sir.
And the CEO is not a director?
I think he's not a director, sir.
Not a director. Because as per central bank's guideline, it should not be less than 7. It should not be less than 7. I will have a look at how it is, because it should be minimum 7. And that too, banks like BOC, so huge, there should be. I will have a look at it. I will have a look at it and clarify to you. Maybe even during the break, I will look at it and I can clarify to you.
Okay, sir. Thank you.
Right.
Sir?
Yeah, go ahead.
Sir, when it comes to that 9-year rule,
Yeah.
let's say one person come and sit for 2 years for the board member, and next year he will be vacate. So after that, again he can be able to go for 9 years or 7 years.
No, someone appointed for 9 years, as far as I can see that earlier also there was a question. I don't think it can be repeated, because I did not see kind of example in the market. I didn't see any directors who are just after the cooling off period coming in again serving the board. I did not see. So I probably feel that there is an embargo. Once you served, you cannot serve again. So that part I need to correct and tell you. So, but then the stint is 9 years. So now it goes as 9 years, and then if you are appointed back, it will be 9 years. But then I have my serious doubt. This also let me check and clarify to you, because I don't think the central bank's intention is that some director having a cool off period and then joining back, and then again serving another 9-year period. As I have my doubts, it may not be, may not be there. It may not be there,
Okay.
because I haven't seen that in the market, anyone who is having this kind of a track record. Like people do serve and then that's it.
So there's an age limit also.
Yeah.
There's an age limit also.
There's an age limit. Yes, I probably age limit is 70 years. I don't know whether I haven't covered here, I suppose. Let me see down the line if I had covered. Otherwise, it is 70 years. You can make a note of it in your notes and keep it. Age limit is 70 years. So someone who crosses 70 years also cannot serve. Now, let us say somebody was appointed to the board at the age of 65. Now, what happens is that he cannot go for the 9 years. In 5 years, he will become 70, and at 70, they will have to retire from the board. So the age limit is 70. Please make a note of it. Down the line, I would have mentioned. If it is not there, just please keep it. Thanks for bringing that up. Any more questions? You must also understand, I mean, on what backdrop this happened. You know that before 2010, there were a couple of years, there had been some corporate leaders who were trying to acquire majority shares of the banks. The risk is that, for example, think of a business leader who is having a group of companies, let us say, various interests, a group of companies. What happens is that if such a business leader acquires kind of bigger shareholding, majority shareholding of a financial institution, the problem is that he will always intervene in the decisions, and he would want his connected companies and all being financed in a biased manner, maybe preferential rates, right? Maybe amounts higher than what you can lend to such a company which is having based on the business and all that. So undue influence they can come and put their weight around in the management, which can end up in the bank failing. You know for a fact that this did happen in the operation of Ceylon Bank. Now, there were a lot of intercompany transactions which the bank found it difficult to recover. And bank almost went into bankruptcy. Then the central bank took over the management. So this is the reason why in 2010 central bank also came out with this kind of a corporate governance code, where these were very stringent. Earlier there were directors in banks, private banks also. You found banks, directors who were serving long years, not 9 out of 9 years. They were serving even 15-20 years. And they basically they were very senior people who are with the bank for such a long period, and then they had a clout, they can do what they want, basically, in the sense, they can influence the decision making. So this is the reason why in 2010 this particular code which were brought in, and thereafter what happened, all the senior directors had to retire. That was compulsory.
So there's a cap on shareholding and voting power also.
Yeah, correct. Shareholding. Okay, I will cover. Yeah, I think I mentioned that in this you will see in this slide that is there. Cap on the shareholding is 10%. Individual person or in consort, somebody cannot have more than 10% of a share capital. But in the recent past, in the last few months, you would have seen government's decisions. They said foreign investors can come and invest. They can. Central bank will allow up to 20%, but within about a 10 years period, that should be brought back to 10%. That the government informed, declared to encourage foreign investments into the banks too. So in this slide, the last point you can see that. So regulatory capital not more than 10% somebody should have. So the non-executive directors also, they will not be considered as independent. They will not be considered as independent if they have more than 1% of the shareholding of the corporation. Right? So that what you mentioned is that 10% is a limit. I mean, I think the limit I should have mentioned here. There's a limit of 10% for an individual, for a company, for a consortium. Like it should not exceed 10% of the shareholding of a bank.
So is it 10 or 15 now?
No, it is 10%, but some banks special approval has been given up to 15%. According to 2010 guideline, it is 10%. But the 15%, whether they increased to 15% recently they gave for 20%, but this 15%.
Recently, 20% given only for that contractual financial month.
Yeah, the foreign investors who come and invest in those, they say 20% can be given, and then over a period of time, 10 years, they will have to bring down the holding to, but it is 10%, not 15%. Even now, if you look at all the shareholding of except for one or two exceptions, which has specific approval by the central bank, others are 10%. The 15% part, I need to check it up, like whether they mentioned that 15%. Let me check on that also, and we will discuss after the break. So independent director should be, I mean, even an employee can become an independent director subsequently, but then should not have been with the bank, during the last 2 years. That is the last 2 years, he shouldn't have been a director. Then they can become an independent director and join the bank. So there should not be any relationship, like, I mean, kind of, some relationship with the director or chief executive officer. They don't become independent directors because they will act in concern. So when we talk about a close relation, will mean the spouse or financially dependent child. Those are the close relation. Otherwise, we don't say that somebody, first cousin or something like that. It doesn't come as a close relation. Somebody representing a specific stakeholder of the bank is not independent. So independent directors don't qualify if they are is an employee of a shareholder. I mean, somebody is a shareholder and then shareholder is a separate company. In that he is an employee. He is a director, means that there is a connection. So he cannot be called an independent director. Okay, the other one also we mentioned that, I mean, somebody having a shareholding and then representing is not a director. And okay, so those are the few things about the independent director. So you need to know the difference between who is a, yes, go ahead.
So what is material shareholder?
Material shareholder is that, I mean, somebody who is holding a share, holding shares, right? Employee of a director or material shareholder means, I mean, somebody who is holding shares, like, I mean, who is, so anyway, the term used by central bank is that material shareholder, somebody who is holding shares. So if you are having someone, an employee from such a person, and represent, I mean, being in the board, we can't call him an independent director because he is an employee of a shareholder. Right. So that's about that is about your corporate governance. One or two areas I want to cover here, like what you said. Maybe a slide I will add with the future ones regarding the age. Age is 70, and then the limit on the shareholding. The recent developments also I will add one slide for you, telling about what are the relaxation what the government gave, so that the government was expecting foreign investment to come and invest in. There are many failed institutions also, like the finance, Swarna Mahal, and all that. Actually, the country was looking for somebody else to come and invest. So for that, these relaxations were given. That also we'll have a slide to look into that. Right. Any questions here? Any questions here? Is Cargill's bank also complies with 15% rule? They should comply. They should comply, but there are specific approvals given by central bank. Now, like, I mean, if they don't comply, that should have a specific approval by the central bank. I remember there were certain, certain requirements by the central bank, and then some interested parties in the shareholding and all that, that the central bank would have given approval. So if there is anyone who is having more than the threshold prescribed by the central bank, that will have specific approval by the central bank. Like, for example, in commercial bank also, history goes back, the insurance company was having 40% of the shares, and then they had to reduce the shareholding, so they sold about 25% to DFCC Bank. DFCC Bank had about 25%, and then they were asked to reduce. DFCC Bank reduced to about 15%. So the 15% had the special approval by the central bank. So probably any bank need to comply with the rule. If they don't comply with the rule, they need to have the central bank specific approval for that. Any more questions? Yes.
Sir, when it comes to that minimum 10% capital rule,
Yes.
so is that apply for individual or company?
Both.
Okay, sir. So then, when we come to that group of companies,
Yes.
that group of company having maybe 2-3 subsidiaries. So is that subsidiary able to capture that 10%?
No, it should be the total. In total, how much they are investing only we'll have to look at.
Okay.
It should be the total. Now they can't have the parent company investing 10% and then a subsidiary company investing 10%. Then what happens is that they will control the bank. So in total, it should not exceed 10%. Any more questions? Shall we go for a 15 minutes break? we will have a 15 minutes break and we'll meet up around 10:50. Yeah, now it is 10:35. We'll meet up at 10:50. Okay. Two questions which came up earlier. In the corporate governance, when we looked at one question came up, I could not find the answer. It's a little bit hazy for me. I need to check a bit more into that. Regarding reappointing or somebody having a cool-off period and then getting reappointed to the board, I didn't see a clear direction. I need to go into the central bank's site to really look at these. I look at it and tell you next time. That is one. The other one is that yeah, regarding the fit and proper fit and propriety certificate or establishing, like what I told you, the process how it happens is that whether a KMP is appointed at the management level, whether it is a KMP, key management personnel, or a director appointed, there is an affidavit which has to be filled up and signed by the company secretary and sent to the central bank through them. It's an affidavit, so which gives the full details of the particular person, whether it's a director to be appointed or a KMP to be appointed to a position. It will give all the details of their experience, their past exposures, where and where they have worked, or what are the businesses, and then what their assets and what are their facilities with the bank, and all the details has to be given in that particular affidavit and signed and given. Now that is the thing which the central bank will go into that and then check and see whether you are a fit and proper person. So if they have any reservation, if they have anything to say that there is a issue, they can always refuse to approve that. So the moment they refuse to approve that, the appointment will become null and void. So that is the certificate of fit and propriety. Right. Any other questions you have in this? Are we done? Shall we go to the next presentation? Okay. Yes, thanks. Let's go to the next presentation. Oh, it's happening here. Okay, we looked at the operational risk, how the calculation of operational risk. Now, like in the Basel II, we spoke about credit risk, market risk, and operational risk. Now, credit risk and operational risk we have looked at, and market risk. Now, market risk at where the risk is arising from. There is a difference you must understand when you are talking about a customer. Customer having a market risk is different from what we are going to see here, right? You will look at, simply when you are talking about market risk, you will say, okay, for a customer is, selling, let us say, vehicles, and there is a market risk because central bank restrictions and all that. There's an issue or whatever. Now, no, not that kind of a market. This one risk what you are looking at. Let us say to the market there's a replacement which has come. For example, now these days, say somebody who was running a, having a rental business, having their building given on rent for conducting classes. For example, let us say, so he was giving the building on rent for conducting classes. The market risk is what with the COVID-19, he ran out of business because people are not conducting classes; they're having online classes, right? So they're not going to hire the place. There's a market risk. So now what we are looking at the market risk as far as the bank is concerned is that the risk of losses on the balance sheet and off balance sheet position arising from the movement in the market prices of those assets, right? So that market risk is subject to capital charge. So it can arise in 2-3 areas. As risk pertaining to interest rate related instruments in the trading book, what we are talking about is that, you see, we have a trading book in the treasury. In your treasury operations, you have a trading book. We may be trading in fixed income securities, treasury bills, treasury bonds, right? Development bonds, that kind of a security. So the risk pertaining to interest rate related instruments. Now let us say the interest rate, what what's happening, what is happening on the other side. I'm telling the reverse side of what the market condition. Let us say interest rates were something like 5%, 6%. We have securities at such rate. Let us say the interest rates have gone up. When the interest rates have gone up, the yield rates on these securities will come down, right? Because these are going to earn less compared to the market. Due to that, the demand for this will be less. The yield rate will be less. So due to that, there's interest rate risk of those securities, right? The risk pertaining to interest rate related instruments in the trading book. That's what we we are talking about. The risk pertaining to equities in the trading book. So we will have risk. Let us say we have a portfolio of shares, equity shares. So we had a portfolio of equity shares of let us say Haley's PLC. We have some shares. Now at certain point of time, the shares was dealing at 330, 340, and then which came down to 130 rupees, right? Due to other reasons, the market rate came down to 130 rupees. So you imagine how much of loss there, right? There's a risk of losing the capital, right? Risk of losing the capital. That's a market risk. Risk pertaining to foreign exchange position, including gold position throughout the bank. Now, the gold, let us say you have gold position. Now, like a gold position in the sense, not your portfolio of, let's say the banks are trading on gold also, in the sense, they buy and sell. They import, and then they sell to the customers. Now, in such a portfolio, you will find if we have bought at say $1,900 per ounce, that's the international price, 1,900. It has come to $1,800 per ounce. So that's a risk of loss. You can't sell it at a higher price. Always the buyers will also look at the market price. Like the foreign exchange positions, what we have. Foreign exchange positions, when you are looking at currencies, our rupee is depreciating. On our commitments, we have to pay more, right? When our balance sheet, we will bring down to rupees and then calculate and see at that point of time if our payment, what we are supposed to make, our commitments, foreign exchange commitments in our foreign exchange position, if you have to pay in that during that time, if the currency has depreciated, I mean, that is more has to be charged to the balance sheet, so that what happens is that you will have a capital loss there, right? So risk pertaining to foreign exchange position. So these are the things which are market. Like what we looked at is that treasury, market position, security prices going up and down, like risk pertaining to interest rate related instruments like treasury bill, bonds, portfolio. In our trading book, we are having a portfolio. When the rates are moving in opposite direction, that is a market risk. Like that, trading in equities as a market risk. As well as in our foreign exchange position, any financial institution, we will have a foreign exchange position, foreign exchange assets and liabilities. They are due to the exchange rate movements, there will be positions created for the bank, loss or gain. So this is the market risk. So like what I told you, don't mix up this with the customer's market risk. So we actually, in computing the capital charge, what is the capital charge we will have to have? We look at the interest rate related instruments in the trading book, right? What is the interest rate related instruments in the trading book? And the equities in the trading book, and foreign exchange risk, right? Including gold positions throughout the bank. Now, for the purpose of this section, the trading book and foreign exchange position will calculate the following, right? I mean, what is the securities classified in the trading account, and open gold positions, open foreign exchange positions. Now, for example, the bullion trading, the banks are doing bullion trading, like, you bring down the bars, you keep it, and then the gold, merchants, from CC to who will buy, who will come and buy. So that kind of positions, you buy and keep it so that you are exposed. You haven't entered into a deal to sell it at a particular price. You are buying and keeping. So that is a position. So looking at the capital charge, what is the capital charge under Basel II? Which is to protect against the adverse movement in the price of a individual security, right? The government securities means whether it is a risk charge, that's normally zero, right? Is normally zero. If it is a foreign government, right? Foreign government and central banks, foreign government and central banks, they are, you need to have the sovereign rate. So the sovereign rate is like, something between AA plus to AAA, capital charge is zero. If it is A plus to BBB minus, right, within that range, there has to be a 0.25%. And you look at the residual term up to the maturity, right? For the 0.25% of that particular period, you will look at the full this one for 6 months. Up to the maturity. If the maturity period is somewhere close to 6 months or less than 6 months, it will be 0.25%. But then, if the residual period, the balance period of that particular security is going to be more than 6 months and not more than 24 months, you need to have a 1% capital charge. Otherwise, 1.6% capital charge under this category, right? So all the rest of the securities that we need to have this 10% capital charge. So we have a table below that will give you the capital charge. Now basically for corporates, specific risk charge for corporates will be based on the external rating. The external rating, how much? Now let us say, for example, we have corporates means your bank has the debentures of a private company you have bought as an investment in the investment portfolio, you have bought and kept, something like that. On that, what is the capital charge you will have to keep for market risk is this. So if that particular entity rating, external rating is AAA to AA plus means 0.25% capital charge. I mean, other rating is like, I mean, you know, like what we explained earlier, it will be 1%, 1.6% or 10%. Based on whether the maturity period of that particular security is whether it is balance period is 6 months or 6 months to 24 months or else more than 24 months. So more than 24 months, so all other securities with lesser, you know, external rating also it will be 10%. 10% charge on the capital, right? 10% charge on the capital. On the amount you need to have a 10% as capital allocation, which need to be maintained. So the market risk is a little bit straightforward. We are talking about the capital requirement for general market, you know, designed to capture the risk of loss arising from the changes in the market rates. Now, if you are working in the treasury, you will understand one thing. Or else, if you talk to somebody in your bank or financial institution who are working in the treasury, there is something like this. Now, let us say you are expecting a payment. Let us say a usance LC, you are expecting to pay $100,000, say tomorrow. 7th of December, you have to pay $100,000 bill you will have to meet. An import bill, which is a usance bill, which you need to pay tomorrow. 100,000 commitment. I mean, if you don't understand usance bill or whatever, forget it. You have from the treasury, you will have to you have 100,000 commitment. And normally, what happens is that there is going to be an outflow tomorrow. You will have a, you know, when you know that this bill has to be paid, you will try to match it up with the inflow. So on any date, the treasury will have a count of how much to come, how much to go, what is in, what is out. So that is positioned. Now, what is the open position which is not covered is what is open for risk. Because on the other when you are covering the position, now let us say I'm expecting $100,000 to be paid tomorrow. So what I will do is that I will see what is my inward remittances, and then also I would have borrowed from somebody. I will say on 7th I want 100,000 from you, right? I enter into a deal at this rate, at this for this period, 100,000, because I know that I'm 100,000 I have to pay tomorrow. So I book it to be borrowed tomorrow. So the deal I enter some time back, right? I know because it's a usance bill, means a LC bill which has to be paid. Maybe it would have been a 3 months or 6 months or type of usance. I mean period, credit period. So I know the commitment is tomorrow. For the commitment, what I will do is that I will book this earlier. So I match my ins to outs. That is the job of the treasury. They will say, I am borrowing $100,000 tomorrow, and then I am meeting this LC tomorrow. Now we are talking about the market risk is that when the unmatched items are there, that only is exposed to the market. Otherwise, other rates are agreed upon. You know, you know that, I mean, tomorrow, even though you have to pay a bill, you already have entered into an agreement with somebody to borrow 100,000 at a particular rate, you know. So there's no market risk for you. So the capital requirement for general market risks are designated to capture the risk of loss arising from changes in the market interest rates. As per CPC, only standardized measurement method is to be used, and capital charge will be calculated only on the net short or long. This is what I'm explaining to you. The capital charge will be calculated only on the net short or long position in the whole trading book, right? What is the net long? It is not the whole of this one. So you will say these are the ins, these are the outs, this is my net position. On that position only, you will look at your risk of loss. So the method of calculation, basically the steps you will go through in calculating market risk is that the price sensitivity of the instruments are taken into account. So you give interest rates between 1.2 to 2% depending on the maturity. So this is what I mean, the expecting that it can fluctuate between these rates. That is why central bank is giving that. So expectation is that 1 month or less, 1 month or less, 2%, and over 1 to 3 months to up to 12 months also. It comes under maturity zone 1, and maturity zone 2 is like in years. So 1 to 1.9, 1.9 to 2.8, like that. If that is so, maturity period is long, so that the interest fluctuation is expected to be lesser than the less than 12 months period. So this is what thought about. This must be the fluctuation for which we need to calculate and have capital allocated. So maturity zone 3, of course, goes beyond 3.6 years. Over 3.5 years it goes. And so there also you can see that the interest rate fluctuation is progressively less, higher the period, lesser the fluctuation targeted. There are two terms in the equities. That about the other securities what we looked at. When we are looking at the specific equity risk, so when you're looking at a particular, specific equity risk is means specific share, right? So the capital charges for specific risk equities is on the all share index will be 5%, right? Now the CSE has a categorization. It was at that point it was Milanka price index. Now I think the sensitive price index, they select out of the lot about 20 shares. For that, of course, 5% will have to be allocated. Other shares, 10% need to be allocated. Right? That is a specific equity risk. You know that I hope you know about the share market. Share market will have whole share price index, which basically covers entire shares traded in the market. And then there is another Milanka price index, and then also sensitive, shares, market sensitive, big ticket, stocks are put together. That it was called Milanka price index. Now I don't know, slightly the name would have changed now, but that's it. That price index, if the stock is within that particular price index, normally they put about 20 stocks into that. 20 companies are in that particular Milanka price index. So if it is in that, 5% capital charge, otherwise 10% capital charge. This is what it means by specific equity risk. The general equity risk normally, it's the overall net position, in the net map, this one you take. So normally it is a 10% thing. So general risk you take, like, you take to look at the long position and then short position of the stocks in the portfolio, and then take the net position on that. You apply the 10%. So let us say you have 10 different shares, and 10 different shares, and on the 10 different shares, of course, you have some shares are long position in the sense. They are performing well in the market, so that, compared to the market investment, you have profitability there. Some stocks which is performing below the market. So you take the net position of that, and then the amount exposed on that, you calculate the 10% and have a share reserve. So this is called a short-term position, short-term method. What banks are supposed to adopt in computation of the capital requirement is that you take the net position, right? Net position, and then in the each foreign currency, and then convert at the spot rates. On the day spot rates, you calculate on a particular date, end of the month, end of the year. Like you calculate into the reporting currencies, normally our LKR. So short or long position you're calculating, and then overall on the net position, on that you calculate the particular capital charge. So for example, let's look at an example how the a bank typically will calculate. So when you look at the, let us say, now we are looking at the balance sheet assets. Those are basically loans. So you risk weight the loans. And then you come to a figure of 458 billion, let us say. So this risk weighting is basically assets like, when you are taking, say, commercial loans and all that, 100% risk weighted, let us say SME loans like 75%, and then gold loans which are given a 0% risk weightage, like that. This is the total of that. Total of your assets have been, lending portfolio has been risk weighted, and that total comes to, let us say, 458 billion. And then you risk weight the off balance sheet assets too, and total risk weight assets for credit risk is 498 billion, say, right? Then you are calculating your market risk. Right? You're calculating your market risk. Your market risk basically capital charge for interest rate risk. For the interest rate risk, let us say 561 million, right? And capital charge for equities is about 61 million. Capital charge for your foreign exchange and gold positions, 143 million. So the total capital charge for market risk, you have 766 million, right? So total risk-weighted assets for market risk, right? It will be, you are calculating this capital charge how much you will have to keep the capital, and then you are multiplying by 10. That is basically your, your 10% is what you need to keep that. According to your calculation, these are 10%. So 100% is 7.6 billion. 7.6 billion is 100%, right? So the market risk, what you do is that this much of capital you will have to keep. Now, for example, interest rate risk, you need to keep 561 million. So 561 million is the, you need to have the allocation. So what is the total of that? Is that 561 million multiplied by 10. That is basically to add to the risk-weighted assets. From the market risk, you need to have the risk-weighted assets. You multiply because you need to total from the credit risk, market risk, and operational risk. Due to that, you are doing. Otherwise, this is the capital you will have to keep, but you need to take the total, and then on that you will arrive at it. So don't get confused here. It is only you know that how much of capital you will have to charge. Of that, you are multiplying by 10 so that you can add it to the total risk-weighted assets for credit risk and market risk. So the next line, when you are looking at it, operational risk. So you have a gross income. Let us say, according to what we looked at, 3-year gross income is given. So your total capital charge for operational risk will be gross income. You take the total of the 3 years, and of that 15%, and then divided by 3, you will have to take. So that part is given. So total risk-weighted assets for operational risk, like what we did for market risk also, what you are doing is that you are multiplying it by 10 so that you can add it with the risk-weighted assets for credit risk along with the market risk. So total risk-weighted assets for A is the credit risk, you have B is the market risk, and C is the operational risk, right? So you are on the same line now. Now you have total risk-weighted assets of 561 billion. This is. So on this only the requirement will be, the capital requirement will be there. So previously under Basel II, you know that total capital 10%, 5% core capital, all that has to be there on this 561 billion. These are the banks calculate. From these 10% will be the total capital, and then now it has gone up to 14%, and then the categories how under Basel III how it goes, we will see that a little later. Any questions?
So what are the off-balance sheet assets in that credit risk? Can you give us an example?
Off-balance sheet item now, guarantees.
Okay.
Yeah, guarantees off-balance sheet item. So because guarantees, why do you call it? Guarantee, it can be claimed. It can be your guarantees can be whether it is bid bond or whether it is credit guarantees or whether it is international guarantees or whatever. The guarantees have the feature of any time it can become a funded facility. So there is a risk. So like that, there are many other categories also there. Even LC open, indirect facility. LC until LC retired. Anyone don't know about LC? When I say LC and all that, anyone don't understand? Letter of credit. Do you understand? I had been talking about letter of credit. I had been talking about usance bill and all that. Do you all understand? Now, letter of credit is an indirect facility because you open the LC and you don't have in the funded facility until the bill is retired, and then until you give a import loan. That's a indirect facility. Any questions? Okay. So this is just to, tell you about, how we are calculating, like, first you calculate your risk-weighted assets. Risk-weighted assets, of course, when you're calculating, you have both on balance sheet or balance sheet items. And then why do we call off balance sheet item is that's not on your balance sheet. Only funded facilities appear in your balance sheet. That's why we call it off balance sheet. Right. So the moment you are meeting the commitment only, that becomes a funded facility. Right. So in the credit risk, you take the total risk-weighted assets like that. Market risk also, we go on reverse way. We calculate the, capital allocation that we could multiply by 10 and take the risk-weighted assets for market risk and then risk-weighted assets for operational risk. Yeah. Somebody want to talk to me? Right. Risk-weighted assets for operational risk also, we calculate backwards. We calculate the, how much capital should be allocated. From that, we multiply by 10 and then take the total risk-weighted assets for the operational risk. And then we total up all these calculated one under credit risk, market risk, and operational risk. And then we come to the total risk-weighted assets on which capital should be maintained. So the capital should be maintained minimum 10% is under Basel II with 5% core capital, and core capital and supplementary capital total is 10%, which under Basel II. Now Basel III, we are in the Basel III. Now the capital requirement has gone up, that we will look at. Are you okay up to this? Are you okay? Anyone wants any explanation? So so now we were my point of touching these things are like, for you to have a background knowledge on this, because you should know, like, when you are talking about this on a lending portfolio, we will be talking about all these capital cost and then capital allocation and pricing. While doing the pricing for loans, we will have issues. How are we supposed to do the pricing of loans? What are the criteria for pricing of loans and all that? We will be discussing these things. So in that, when you are talking about that, this is very important. How risk-based, based on the risk, how the pricing is done. So capital allocation is one of the important criteria. So we need to be mindful. What kind of a facility we are giving, what kind of asset is this? So now, so on what criteria we are going to, do the capital allocation to this, and then are we taking the capital allocation cost in pricing this particular asset? This is very important consideration. Any question up to now? Are you all okay? Now, under normal circumstances, what happens is that I used to have these class assignment sessions, like you all do the presentations, group presentation I used to have. So that actually, on areas covered, we used to have group presentations, and then that really, gauges the knowledge or increases the knowledge and all that. So anyway, this time I'm not able to do that. So basically that particular part which is vital as far as I'm concerned is not happening. So please, as we go along, ask your questions, clarify on anything. So we have covered a bit of a bigger area when it comes to with the fundraising, different ways of fundraising, different instruments by which you are doing, and then fund management, and then your ALCO management, and then how the decisions are taken by the bank, how the products are launched, what the criteria for launching products, and then how the assets are how do you choose which way to raise funds. All these areas we have covered by now, and then we have touched on the regulatory capital requirements. So on the regulatory capital requirements also, we have come to the level of talking briefly about the Basel I and then Basel II. We have looked at the capital, how you calculate the capital under the Basel II requirement. There is little bit more to go, on this. I will touch on that anyway. Are you all okay up to now?
Sir, can you explain more about this component of capital in here shown? What you are shown?
What capital?
No, in this slide, it is component of capital is there. So can you explain it more?
These computation of risk-weighted?
No, sir. Not this previous slide. No. Go forward. This is what component of capital. It is there.
Right.
So.
Right. Okay. I haven't come back to this. Right. This I will explain to you. Right. Okay. Now the new requirement is the new capital requirement under the Banking Act of 2016. Direction 12016 is that the capital from the previous definition, it has changed. So the previous definition, we looked at Tier 1, Tier 2 capital, right? Tier 1 capital and Tier 2 capital. Tier 1 capital is core capital, we called it. Tier 2 capital, supplementary capital. So we said that Tier 1 capital, core capital should be 5% of the risk-weighted assets, and Tier 2 capital, Tier 1 and Tier 2 should not be less than 10%. So that is the capital requirement even up to Basel II. Now the current capital requirement which has come to being is that there are three areas which are mentioned: common equity, Tier 1, right, and then total Tier 1, and then the total capital ratio, including capital conservation buffer. So the common equity Tier 1 is including the capital conservation buffer is what almost the thing of our previous core capital, right? Previous core capital. The previous core capital basically takes the form of Tier 1 as plus total Tier 1. Total Tier 1 part of it also covered under the previous Tier 1 thing. And the balance only you have the supplementary, and then what are the documents, what are the instruments which can go into this, what are the ways the capital requirement can be convinced is something the central bank has given a detailed sheet. I probably feel that I need to include another thing here, but going forward I have few more sessions also on this. I will cover that elaborately. So they have broken into these, tier 1 capital, and then including the capital conservation buffer. Basically, they create a buffer now in the, to observe the shocks which the bank can undergo when there is a serious erosion of capital. How do you face this? Survive in the market is what the purpose of this particular conservation buffer, capital conservation buffer. Additionally, so the instruments which are to go into these, like what I told you, I will share with you later. There's a schedule. There's a bigger schedule in that we can look at it. So the total tier 1 capital, including the conservation buffer, goes to 8.5%. 8.5%. The total capital ratio, including the capital conservation buffer, the supplementary and all that, goes up to 12.5%. Basically, these were less than 500, but then more than 500 billion capital means banks will have to have a higher capital requirement. So these are called, domestic systemically important banks, so that the capital requirement goes up. So from for those banks, from about 12.5% for less than 500 billion capital banks, it is going up to 14%. It's going up to 14%. Under the COVID condition, it has been relaxed to 13%. It can be you can have it 13%. So the total tier 1 capital also has been relaxed to 9%. If you can see in the last column, you can see the total tier 1 capital is 10%, which also has been relaxed to 9% temporarily under the COVID conditions. So that the total capital ratio is 13%. So we will see now. You will see in the market there are many banks which are actually announcing Basel compliant, Basel compliant debentures. They are issuing debentures, which is in line with these building up the capital. There are many banks also. You will see they are trying to attract foreign investment. Get the foreign investment like IFCO, like other multilateral funding agencies, fund managers, multilateral fund managers, to come and invest in the capital, capital of the bank, so that the capital can go up, right? Otherwise, how do you build the capital? Like what we discussed earlier, you can build the capital by way of either not issuing dividends. So if you don't issue dividends and you capitalize the retained profit, the profit, you put it to retained profit and keep it. So that is part of core capital, becomes part of core capital, and then you build up your capital by that. That may be one. But then the shareholders may not be happy. Shareholders would like to get something. Shareholders are not happy. Just the bank is taking the profit and just keeping it to themselves, and then we have invested, and so they will make a fuss. So you need to manage the stakeholder demands also. So there are other ways. Other ways are what? Like you, instead of issuing cash, issuing dividends, cash dividends, you issue bonus shares, right? You issue bonus shares. So let us say, for example, you give a 1% bonus share, means somebody who is having 100,000 shares will get 1,000 shares bonus. So they're not going to get cash, but they are getting the bonus shares. That means that is given free. So what does the bank achieve? The bank achieves that they are not actually not paying out cash, but they are increasing the share capital by using the retained profits, right? So it's a win-win situation for the shareholders in the bank, because shareholder is getting something. He has got 1,000 shares extra. So if he really wants money, what he will do, he will go to the share market and sell that 1,000 shares, which is not going to affect the bank, right? So you will go and sell that 1,000 shares. So that is a bonus issue. So one way is keeping the retained profit. The other way is issuing bonus shares. The extreme things are what? The other one is you go and issue rights issue. So let us say that today Sampath Bank shares is 130. So Sampath Bank wants to raise capital. Sampath Bank goes to the market and says, we will issue say 5 million shares at 115 to our shareholders, existing shareholders. The right is given, the first right of rejection is given to the existing shareholders. So they have the right. So they have the right to buy. So let us say somebody is having, like, if they say 1 for 10, somebody is having 10 shares, you can buy 1 share at 115. So the existing shareholders will buy the shares. If they don't buy, others will buy, right? Others also will apply. The people who are not shareholders also can apply. So they will apply in, when other the shareholders are allocated in the balance, there are shares. Those shares will be allocated to the people who have applied, who are not shareholders. So that way the rights issue is being done. In the rights issue, the other one what I wanted to tell you is see, somebody is having 200,000 shares and he has a 2,000 share rights. Now this is regarding the shareholder benefit. Now if you are a shareholder of Sampath Bank, you have a right to buy 2,000 shares at 115, which currently is selling at 130 in the market. Now you have the rights. So you need to invest 2,000 into 115 to buy the 2,000 shares. So you can buy. Or else what you can do is in the share market itself, you can sell the rights what you have. The rights are also traded. Say somebody is buying the rights at 15 rupees. The prices will go like that. Okay, market price is 115. The rights coming at market share is 130. Market price is 130. The rights coming at 115. So somewhere like 15 rupees, people will be willing to pay, or less than something like that. So now what happens is that somebody who has a 2,000 rights, who is not going to buy, because 2,000 into 115, he doesn't have money to go and invest now. He is selling the rights in the market. So he will get, let us say for 10 rupees he is selling. 2,000 into 10, 20,000 he will get his rights. So he is encashing his right. So somebody else will buy that right for 10 rupees and go and buy the shares at 115, and then for their cost is 125, and 125 market is 115, still they are up on the deal. So by way of shareholder benefits, also rights issue has this kind of benefits. For bank, for a financial institution, they are able to raise additional funds without other financial cost. In the sense, they are not going to pay interest, right? They raise capital, and then that comes to this particular tier 1 capital. It's a core capital, right? Any questions on that?
So private placement, how that happens?
Private placement, right? Correct. Good question. Now, what happens is that private placement is that now when banks are having a large shareholder, large investor coming in. For example, let us say IFC wants to come and buy. We go for a deal with IFC. International Finance Corporation. These are arms of World Bank and all that. I mean, these guys are, they don't look at, I mean, they will look at 50 million, 100 million to $150 million. So for them, they will negotiate. I am willing to invest in your shares, and they negotiate. Now your market price is, let us say your market price is 130. Let us say for Sampath Bank, market price is 130 rupees. Now market price is 130 rupees. They will say, okay, I am willing to come and invest $100 million in your company, but you must issue the shares at 100 rupees. So the bank will look at the pros and cons and see whether it is worthwhile at 100 rupees, but then 100 million capital infusion, fresh capital coming. So they will get the central bank's approval, and if they have, if it is okay with them, they will go in for $100 million at 100 rupee cost. They will have additional shares. These are not existing shares. They will issue additional shares that will add on to the number of shares. Additional shares at 100 rupees, and that actually, you know, strengthens the balance sheet because the additional capital is coming. So that is private placement, right? So a large shareholder or group of shareholders who are actually going for a significant investment will be issued with a private placement with due approvals. So the approval needs to come from central bank. Central bank, they will have to say, yes, okay, dilution. And this has to be placed in a extraordinary general meeting of the if it's a public limited liability company, you need to have an EGM to decide on that. Shareholders' approval is needed at a EGM. At a EGM, extraordinary general meeting, you table it, and then shareholders' approval needed, and thereafter central bank approval needed, and then you do that. That's private placement. Are you okay?
Yes, sir.
Okay, right. So that's great. So that's about you know, raising capital. Raising capital by way of you know, shares happens this way. Otherwise, you have you know, issuing debentures, commercial paper and all that. Not that much is there. You issue the debentures, so that way you know, increase the capital. That's supplementary capital basically. Debentures doesn't come into the core capital. It is supplementary capital. Right. Any question here?
So if that any big investment coming from IFC or any kind of thing institute, is that cover that 10% maximum capital requirement?
I didn't get you. The first part I didn't hear.
So when it comes to that big investment like IFC kind of thing,
right.
So is that come to that maximum capital limit, 10%?
Yeah, it can even come to 10% limit also. Those are extreme situations. I mean, they don't come and take 10% this one, but then yes, there had been enough of instances in the past. IFC has taken 10% holding also. I mean, they sometimes buy from the market, they sometimes go for private placement. So if it is, if the bank is in need of a bigger capital, even it comes up to 10%. There had been in the past many instances where IFC was holding about 10% in banks. So IFC also does time to time. They hold the shareholding, and then when they get a good this one capital gain, they will sell it off also. So they have the clout. Basically, what they will do, they will negotiate with the buyers. And if the market is good, and then when there are fund managers, overseas fund managers also, who are willing to buy this chunk what they are holding, and if IFC can make a good capital gain, they will sell it off also. So they go up to minimum of 10%. They go up to that. Now, given the fact that, for example, let us say a failing institution, IFC want to come and invest in, say that it's going to be revived or whatever. They can even go for 20% of that, 20% of the shareholding, and then they can go and invest in, take the shares, and then see that it is revived, and later they will sell off. Okay. So are we all comfortable here? Understood? So the discussion, of course, on these, the further, now I will have to bring in the instruments which are coming into these. What are the instruments which are coming? I will throw more light into this. This one slide is there on the regulatory capital requirement now for the banks, but I will bring in more information into that. What are the components of this common equity tier 1, tier 2? There's no tier 2 anyway. Common equity tier 1, and then the total capital ratio, and the other components. I'll put slide with more explanation. So that being said,
Excuse me, sir.
Yes.
Hello. Sir, normally banks are issuing debentures for raising capital now. So I have heard they are issuing debentures such as Basel III compliant, Tier 2, unlisted, unsecured, subordinated, redeemable debentures like that. So what does it mean?
Basel compliant thing is that, what do you mean by Basel compliant debentures is that that qualifies to be counted within this particular capital. The total capital ratio, under that it can be counted. So that is the Basel compliant that needs central bank's approval also. Once the central bank's approval is taken, to issue Basel compliant, debentures, they go for that. So that will have other attributes of, now the Basel compliant debentures also I will cover in another thing. It has a host of other features also, like what it means to a investor, what are the do's and don'ts, what the investor can do, kind of things are also there. And along with that, it has the features what you mentioned, that redeemable debentures. Redeemable debentures we discussed, after a particular period, the bank will pay and take it back, and interest at a particular rate they'll have to pay. Those are the general other features of a debenture. But Basel compliant debentures, of course, has some other attributes also. Those listed attributes, I need to put it into a slide for you to in another another session. So that actually complies with the requirement, and then it can be considered for the capital requirements under this.
So the main attribute is the convertibility to the equity, I think.
I didn't get you.
The main attribute of Basel compliant debenture is that bank has an option to convert it to equity.
Yeah, correct. Yeah, that is one of the main attributes, because central bank wants this strengthens the capital of the bank. Now there is an option. If the customer doesn't want, if the investor doesn't want, no, but there's an option, right? After a period of 3 years or 5 years, it can be converted to equity. So yeah, that is one of the attributes of Basel compliance This one. So that we will look at. I mean, that's an important area anyway. In capital building, that's an important area. Basel compliant debentures. I will put it into another slide anyway. Right. Any other questions here?
And the significantly important banks, how they define?
Yeah, they actually they call it. It's called DSIBs, domestic significantly important banks. Domestic significantly important banks as the criteria, like, I mean, based on the size of the institution, you look at the the size of the institution, and then basically the turnover, the profitability, and the coverage in the country. How, if anything happens to an institution like this, what kind of an impact will it have on the economy? So that decides these criteria decides the importance of such an institution to the economy. Then they are categorized. Normally you will see all these above 500, out of the above 500 billion asset holding bank only it will come. Looking at those criteria, central bank says these are the domestic systemically important banks. So domestic systemically important banks will have about 1.5% more capital to be maintained compared to the other banks. So the failure, the basic thing is that any issue or any failure temporarily or otherwise from these institutions will have a huge impact on the economy. Economy will be affected, the country will be affected by such failure. So due to that, at any cost, central bank or the government doesn't want that kind of a organization, that kind of a bank getting into unnecessary trouble. So to make them more prudent, capital is increased. You need to keep more capital so that any problem can be faced without an issue. Yeah, any more questions?
So what are the criteria central bank using to divide this systemically important bank and other banks?
Yeah, that's a good question. I mean, these are the things what I told you, the size they will look at, basically. The size, how the branch network, the size, and in the sense the volume, business volume, and the profitability, customer base, these issues are looked at. I hope I will put a few more things into the next slide also. That also is important. So now in Sri Lankan context, of course, from what I say is that, I mean, you can see the bigger banks, like, I mean, People's Bank, Bank of Ceylon, like Commercial Bank, HNB, Sampath, all the time these are banks will come into this kind of categories.
So as a current context, how many systemically important bank in Sri Lanka?
There is 6.
In the private and
six,
and government also.
Yeah, altogether about 6 systemically important banks are there. 6 are there.
Okay, thank you, sir.
Yeah. So basically, we have covered what I wanted to speak to you today, and now of course we can have a general discussion on areas what we have covered. So a few minutes we can have a general discussion, and you can ask your questions. So all of you are bankers, is it? Any non-bankers here? The other day I saw a student was there, I think. There was a student. So now a few things what I was telling you in the past also, like, I mean, you must keep in mind in the Sri Lankan context, in the Sri Lankan market conditions, now having a balanced banking industry is very important. Okay, all these capital building and then maintaining the bank's stability and all that is very important. But then the market also should be with all sorts of other institutions which are somewhat lacking, I would say. People who are into venture capital funding, the asset managers, like what do you call it, investment bankers, then the development banks. These are all important part of economic setup where for the economy to grow, the appetite of the institutions are not the same. Now, when it comes to a development bank, when it comes to a what do you call it, angel financing, or the venture capital companies and all that, they will look at specific projects. So whether it's a small or big or novel or all, I mean, they will look at those projects which are actually very required for the economic development. Now, banks going and funding those things, of course, they'll be little reluctant to go and get into this, unknown territories where expertise is needed. Now, like what I told you, like, I mean, any new development which is coming to the market, which needs somebody to look at that and then understand what this particular engineer or the inventor or the entrepreneur is talking about. The entrepreneur may be talking about a new thing. He wants to bring in a new thing, and which may be very good for the industry. Maybe it may end up in exporting. It may end up in bringing in foreign revenues and all that. But then it may be in the midterm to long term. But at the beginning, you need to give the sufficient support to that kind of a venture for for them to flourish. Otherwise, what happens is that the way we are financing amongst the banks is mostly we will look at the trading business, established businesses, established factories and all that. Okay, they do. Otherwise, a lot of trading taking place. People import and distribute and kind of a thing. So the new industries coming in. I mean, people who want to do a new thing, new venture, IT developments and all that. I mean, unless there are this kind of institutions which are in the market developing that, there will be a dearth in the market. That is why I had been talking to you at length about the venture capital companies also. I was talking to you earlier, NDB Bank and DFCC Bank, they were doing specific development banking. That actually was very good for the economy. But unfortunately, down the line in NDB, DFCC and all have gone into commercial banking. So probably the intensity of the development side of it has come down as a whole in the market. So those are the few inputs on those things. And then any questions? Any more questions?
So when it comes to that finance companies context, so how these Basel Accords are applied to them? So probably they will not be able to maintain that 500 billion risk-weighted asset mostly. So how these Basel Accords are applied to them?
Finance companies have a different, it's governed by the central bank, but then central bank has a different guideline for the finance companies. When it comes to capital requirements and all the minimum capital requirements are there. The central bank prescribed minimum capital requirements are there for finance companies. So they don't expect them to fully comply with the Basel requirements, but they want the Basel requirements are going for commercial banks, and finance companies have minimum capital requirements. Like so I think it's about 8 billion. So local, for foreign companies, for them to come and invest. Foreign banks, they need to have a 20 billion capital, and finance companies, I hope it's about 8 billion. I can clarify to you in the next this one, but it's about 8 billion. So central bank prescribes to them. So the intensity of applying the Basel requirements is not that much for the finance companies. Finance company little lenient because their capital is very small, and the balance sheet cannot be maintained the way that is expected from the licensed commercial banks, because many of the finance companies cannot raise deposits also for their lending, so they need to borrow from commercial banks and do the lending part of it. So their loan book is a little bit risky also. Some of the finance companies, their loan book is a little bit risky. So this is very sensitive to the market conditions. So their requirements are a little lower. That I will cover. I can understand what you're trying to say. We will cover it up, but keep in mind that their requirements are lower. I mean, the minimum capital requirement MCR is prescribed by the central bank for them. Even for foreign banks, they have prescribed, but then those are like, foreign banks is about 20 billion. Now, finance companies, of course, depending on the size they have given, and then it's about, highest is about 8 billion.
And this budgetary proposal of financial institutions to be consolidated, how that happens in the market?
Actually, during the previous time when the current government was there, the current prime minister, when he was president in 2014, also the pressure came in the market, like all the big banks should acquire smaller financial companies, like one or more should be taken and consolidated and all that. That is good, but the problem is this: it's a big challenge. It's a big challenge. Why? The way the banks are running, the amount of regulation of the banks very stringent, so that with that kind of a culture, every bank has a kind of a culture. With that kind of a culture, to take a finance company, which sometimes are family companies, family-owned companies, which are run according to the family values and all that, lots of leniency, lots of compromises. Amalgamation will be a nightmare. It's not an easy thing. So you expect to amalgamate and then take the employees and then run with the employees, and then so that the bank's culture will have to go there. It's practically it's a difficult task, but still, for all, many of the banks did in 2014 period when the government wanted that to be done. They did, and then many banks had their losses also booked and all that in doing that. So, so the problem is that in our market, the way the finance companies are operating, the way they are managing their assets and liabilities, except for a few number of established finance companies, others are vulnerable. And then even amalgamating will be a problem. The bigger banks may have to then take those and then run as a separate thing. You can't amalgamate. That's the problem. That's the outcome of what happened in the past also. So the banks are running separately, separate subsidiaries, taken and then running that as a separate subsidiary, separate finance company, because of the challenges of amalgamating. Good question. Yeah, good question. I really like you all thinking on these ways. I mean, that's the way to, you know, you all will have to think, you know, on these lines, not operationally at a lower level or whatever. Strategically also you must think. That's great. Any other questions? Any other questions from you all? Right. If you don't have any questions, shall we wrap it up for the day? Okay. So till we meet next time, next Sunday. So on these lines, what we looked at, I mean, go through that, you know, gain knowledge. I assure you that I'm not going to go and look at all your calculations and then I'm not going to test you like whether you can calculate how the capital to be calculated under Basel II, how to calculate the credit risk, market risk, and operational risk, and all calculations. You know, I won't test you. I won't tell you. But then qualitatively, you must know these are things which are happening. So that's very important. So thank you so much. Have a nice weekend. Have a nice evening.
Sir.
And
Thank you, sir.
yeah.
Thank you, sir.
Take care. Take care.